Hey. Good afternoon, folks. This is the Finance Morning Show, dropping in the afternoon today. I had to take care of a few things this morning, so we're behind time on schedule, but we're still bringing you this podcast live. For the people who want to drop in live, this is the Finance Morning Show. This is the F&E podcast, and I'm your host, Akili Paige. Thank you. Thank you for joining, everybody. Want to start this day off with some words of affirmation, and it states, I think of a hero as someone who understands the degree of responsibility that comes with his freedom. Right? Want everybody to take a second to think about that one right there. I think of a hero as someone who understands the degree of responsibility that comes with his freedom. In your daily words of motivation states, I want to thank a few special people who check up on me from time to time. That means so much more than you know. So diving into our words of affirmation and words of motivation of the day, heroes comes in all shapes, sizes, forms. Their degree of responsibility, it separates at different levels depending on what kind of hero, what situation the hero is in. But don't none of that come unless he understands the responsibility of his freedom as well. All right? You cannot be trapped in any present if you want to be a hero. I also want to thank a few special people who check up on me from time to time. That means so much more than you know. As everybody know in this world, even though as we stand alone, we all need somebody there for us, no matter how strong, how tough, and resilient you are as a person. You know, it still takes a few special people throughout the day just to make sure that you're okay, that you're doing fine, that your health is fine, that your mental is fine, emotional, financial, just anything, anything that can be anything in the world. Just because as human beings, you never know what situation another human being is going through. So for those special people right there, they can help more than they know. So last episode we kind of left off on assets. I wanted to keep on bringing in talking about the assets. Shout out to the viewer we got out there. Shout out to that person out there viewing. I like to shout out the people that stay in contact, especially while we live. I appreciate the people who also go and view the recording separately, but the ones that stick with us live, no, you mean more than you know. You know what I'm saying? Those are special people. So, yeah, like I said, we left off on assets last Monday. So, and I kind of, briefly went over what an asset was, what you kind of want to do with an asset, and what contributes to assets. And if you don't remember, it's revenues and assets correlate with revenue. So, we're going to dive in deeper on assets today because, as simple as it may seem, it can be complicated as well. So our very first asset, and the very first asset that's on your balance sheet, that should be on anybody's balance sheet, is cash. Cash is the very first asset that is on people's balance sheets. And that's just the difference between your cash receipts and your recorded total. That's how you come up with your cash totals on assets. Another thing with cash is petty cash. If you don't know what petty cash is small amounts of money on hand that you use to take care of things. A lot of people call this like a rainy day fund. That's personal. That's for personal finance. For business finance, they call it petty cash. So to correlate the two, I would like to, for people who just want to build their personal finance and who's not really worried about business finance, petty cash would be your rainy day fund. And under your rainy day fund, you kind of use that for situations like car maintenance, doctor visits, medicine, anything that's handled where you use cash on hand. You have to get into having petty cash on a daily. So having a petty cash fund on a daily for instead of just having it on rainy days would be efficient for personal finance. A lot of people don't have rainy day funds, so that is one thing that can be accounted for when you're trying to self improve and build your financial freedom. Now, the second thing under assets I want to talk about is accounts receivable and notes receivable. Um, this under personal finance will kind of be like creating a service for somebody that you create revenue off of. So um, it could be gambling, for instance. If you have created a bet for somebody, that person would represent an accounts receivable. Um, So under business, accounts receivable is basically a person that comes in and make a purchase. Like if you go to a grocery store, you go in and make a purchase. That business is creating an account receivable for that purchase that you just made. It certain businesses collect certain information for their accounts receivable, meaning different businesses might ask you for your email, your first name, your last name, your phone number, your address. That's just so they can keep in contact with you and do further business. That's how they keep their accounts receivable going and their notes receivable going. Notes receivable is kind of the same thing as accounts receivable, but notes receivable it is long term, meaning it usually lasts over 6 months. So if basically if you have a loan to somebody, if you lend money to somebody, you say, hey, you don't have to pay me this back until December of next year. That's called a note receivable. You just created a note receivable with the person that you just created that loan to. Personal finance and business finance, they kind of correlate the same way when you talk about assets, liabilities, equity, revenue, expenses. Now, things people run into when you create accounts receivable and notes receivable is uncollectible amounts. And uncollectible amounts is exactly what it says it is. It is uncollectible, meaning the person does not pay you. The person may pass away and can't pay you. Um, it's just any unforeseen circumstances that may come about that you know that you're not going to receive the loan that you just built out. Um, that's called uncollectible account. You kind of just you would write under an account called write-offs or bad debts under personal finance. You would just call that a law. What I'm going to try to do is I'm trying to correlate all business finance to personal finance so y'all can understand it. Also, businesses and things when people come to view these things, they can understand it as well. Um, I just went over account receivable, note receivable, cash, and petty cash. So let's talk about long-lived assets and related expenses, assets for future economic benefits, intangible assets, cost of assets. These things all matter when you're trying to generate revenue off of the assets that you have. I remember last Monday, I was talking about your phone being an asset, or just the personal items on you, using them as assets instead of just using them as entertainment. So you're now I'm just use the phone again, for example, because everybody has a phone, personal and business. Um, it is a tangible. That is called a tangible asset, meaning it's something that you touch, but it also has intangible things built within the phone that you can use and generate assets off of as well. Meaning, intangible as in the camera, the microphone. Those things that is built in on that phone, you can't touch those things, but you can also generate revenue using them as well. Um, the cost of the asset. So, that's a big thing. When we purchase things, the cost is the main factor in why we're buying these things that we purchase. So, um, the cost of your asset is meaningful because you kind of want to forecast how much you're going to make off of the price of your asset. If I go out and let's just say I wanted to, here we go, my mowing and pressure washer business. I wanted to start my mowing and pressure washer business, and I knew that my first asset was the lawnmower. The lawnmower had cost me $149, if I'm not mistaken, 149.99 after taxes. The probably cost like 162. Off of my first asset, or just the cost of that first asset, it was $162. When you're doing the landscaping business, forecast to generate revenue well over $162 because you know that you're going to have to purchase probably another lawnmower, some rake, shovels, just any landscaping tool that you may need, hedgers, edgers, just any tool that you need to finish a landscaping job. So from the cost of that first asset, you have to generate the revenue to start to buy more assets. So, and I say this and I kind of stumbling over my words because this is important. I want y'all to get this, so just bear with me. But the cost of your first asset will then be the basis of how much revenue you will want to generate for the future. So if you go and buy a cheap asset as your first tool, you could kind of forecast that you probably won't be working that long before you end up buying your next asset, which is important because do you have the finances to take care of them responsibilities, to handle it? And a lot of the times when you first starting off a business, we don't have the finances because that's why we're starting a business. We're starting a business to generate the revenue to create financial freedom. So back to the phone. The purchase of your phone, because we're talking about personal finance now, the purchase of your phone can be very instrumental because we need to know if you're using that phone for entertainment purpose, for financial purposes, for business purposes, for social purposes. Like you have to think about all these things when you're purchasing assets. And a lot of the time we don't think about these things because it's just a instant gratification. We're going to purchase these things just to satisfy ourselves for that time being. And that causes us to lose revenue instead of generate. Um so that is very important when we're talking about assets as well. The cost allocation methods, I'm not going to talk about that more so because cost allocation method is for business. So personal, to kind of correlate that to personal finance, is kind of basically budget. Just basically recording depreciation is an asset as well. It's called a contra asset. So basically it's the negative of the asset that you buy or bought. And shout out to that viewer that's still out there. So let's just say over time, okay, let's use a vehicle because a vehicle depreciates as soon as you drive off the lot with it. Okay. So even though that vehicle depreciated in value, it's still worth something. So for personal finance, you just you have to know like the computer that you buy, the game system that you buy, clothes you buy. I don't know people because people is into reselling clothes. So clothes that you buy, if you into collect the items, things of that sort. Um, that type of stuff does depreciate. The more times you wear it, the more times you use it. Uh, Humans depreciate. Let's use that as humans depreciate. We can use that as person. It's just over time. Over time, you have to know the things of value go down. That's all cost allocation is. So when you're buying the cost of your asset, the cost of your first asset, you have to know that that asset is going to depreciate value as it's being used to generate revenue. And again, this is why I want to make it important to know that when you're buying your asset to generate your revenue, please, please do not be cheap. Go ahead and use what you can and make, surplus to make up for the loss that you had just bought on the asset. So, um, inventory, inventory. Here we go, because inventory is a big part of assets as well. Um, Especially for people out there that's trying to build their own business and get to the next level. You have to be real critique on inventory, real finicky on inventory, and kind of like hawk over it because ultimately your inventory is what builds you up to self-improvement, financial freedom, and the next level of business in corporate world, also in the personal world as well. So, and there's different ways. There's different ways of keeping up with your inventory. A lot of businesses they use weighted average, specific units, FIFO, LIFO, which is first in, first out, last in, last out. Um, just many different ways to keep up with your inventory. If a lot of people use unit production, double declining method, it's that's off of depreciation. But inventory wise, a lot of people also do hand counts, like inventory, like uh, actual physical count, and that's usually what people in personal finance do. They use hands-on counting so they can keep up with the number of items that they have to sell or to our services they have to give. Inventory is important. You have to kind of know. You have to know how much inventory you have because you have to know how much money that you can possibly make. Now, although you may have a certain amount of inventory, the forecasting amount will not always be exact because you have the total and discount and things of that sort. So just inventory is just important, period. You just have to know what you're doing and how you want it done, which is basically a blueprint. So could talk about depreciation. I really don't want to dive too deep into depreciation. Depreciation is more so for consultant service. If you want to know about depreciation, you can go to www.apmax tax service, schedule a consultation. I could kind of go deeper into depreciation for you. Depreciation is more in detail for the podcast. I don't think the podcast would be. I don't think it would be informative doing depreciation on here. I would rather do that. But let's shift to the next thing. So we went over assets. Okay, we went over assets last week. We finished it this week. We done with assets. If you need any help on assets, any question about assets, any concerns about assets, if I did not cover anything about assets that you want to know, please leave the comments. Leave the comments, leave the question. I do respond. I will respond to them. But next, we're going to start on liabilities. I could tell we're probably not going to finish liabilities today, but liabilities is also called obligation. Obligation. Okay. These are things that you have to take care of. These are things that other people have to take care of. These are things that make the world go around. Payroll. Payroll is the first obligation for a business. More so personal finance, business finance. Payroll deductions, payroll entries, the cost, salary of workers, the hourly workers, vacation paid off, the time paid off, things of that sort. These are all obligations that business finance have to take care of. That's probably the very first thing that they take care of when they start in their businesses. They create a payroll bank account actually, because they know that they're going to have employees that they need to pay on a weekly, monthly, yearly basis. Liabilities. So just like assets, there are liabilities, there are current liabilities, there are long-term liabilities, short-term liabilities, contingent liabilities, lease liabilities. It's a number of liabilities, just like it was a number of things with the assets that we're going to go over. So to kind of start over, let's talk about current liabilities, okay? And I do have notes. So I'm kind of going between notes and brainstorming, going off the top of the head, giving you the knowledge that you need to know. So accounts receivable, if under assets, if we have accounts receivable, under liabilities, we have accounts payable. Okay. So, and accounts payable can be current or it can be long term. So basically, if you're the other end of the person who's giving out the asset, meaning the person who's asking for the asset or asking for the service from another person, this is the side of the stick that you're going to end up on. And basically, all this means is same exact thing under assets, just vice versa. If you are alone, or let's say if you make a bet, the game, on a basketball game, that LeBron James is going to score 25 points to your best friend, and you're on the losing end of that side, you now have the accounts payable, meaning you have to pay your friend whatever the amount of your bet was. So, or let's use it under personal finance. If somebody lends you a loan of $700 and they say, hey, you don't have to pay this back till next year, that is called a long-term account payable. And these are liabilities basically that you know that you have to pay or that you owe to someone. Again, the only way that people kind of get out of liability is not paying. One, two, I hate to keep using that, but passing away. Three, just the business closes. Just things of that sort would terminate your account payable with person or business that you had established. So another example of long-term liabilities and bonds. A lot of people use bonds when it comes to larger amount. Loans is kind of smaller bond. Retirements of bonds payable, meaning just these are all things under business finance. Personal finance, you probably wouldn't benefit too much from this because I don't see how a person trying to build personal financial freedom, I should say, person trying to build financial freedom will be using retirement on payable because personally you can't pay yourself retirement. You would have lease liabilities. This is like operating lease, capital lease, renting lease. That you can correlate into personal finance for people that rent homes, for people that rent U-Hauls, for people that rent trucks, cars, and things of that sort. That's called lease liabilities. Um, Usually within lease liabilities, they do have discounts. You have to kind of abide by the terms to get awarded the discount under lease liability. Same letter to be used twice behind each other. But only that's the only way you can kind of correlate lease liability to personal, more so for business. And actually, I thought we won't get over liabilities, but we actually just did get over liabilities. Liabilities are just done, but we actually just went over every liability that's possible to have because we explained what asset was. You know what an asset is. We now know what a liability is as well. So if you remember my acronym from last week, I used all of our eyes, reveal expectations. We just did the AL that acronym. So equity would be next. And this is called the accounts. Like I'm going over account basics with you so we can understand what accounting is, what finance is, how we can obtain financial freedom for the future. In the next couple of episodes, we'll be kind of diving into real life situations, things of that sort. Every person we can swivel our way to financial freedom. If you're watching this, hopefully, gain a bit of knowledge to help you throughout the day. That's the reason for the finance morning show, so we can kind of get everybody day up and going. I apologize for it dropping in the afternoon today, but sticking with it. Now let's talk about owner's equity. All right, let's talk about personal equity. Okay, we're just going to talk about equity in general. Equity. Equity is how much you own, how much of everything is yours. So, meaning how much of assets is yours, how much is mine. People can get confused on equity because you can have a negative equity. You can be worth negative, meaning people will not want to buy you because you already owe more than you're making. That makes sense. That means you have more liabilities, you have assets. Okay, we remember assets generate revenue. Okay, you don't want to generate liability because your equity is stock. Stock is the first most important thing of words. We use it in the word equity. We use stock being sell. What contributes to stock is capital. Capital, earned capital, your contributed capital, meaning people investing into you. This can be under personal finance. This can be somebody viewed as your mother, or your father, your brother, or your sister, whoever it is on a daily basis that pushes you to to do better or be better. That can be included. Contribute to you. Okay, so earned capital is basically all credits or credit that you have left over from the debit of your asset you have. If credits left over, that would be your earned capital. Your issuing stock is the stock that people is investing to you in. And this is I'm going over business finance correlating to personal preferred stock, donated capital, donations. People, um, hosting this podcast, I tend, or hopefully I will generate donated capital. I hope that one day people see that this podcast is informational and donate to keeping this podcast growing instead of stagnant in one position. Treasury stock, environmental stock, crazy. When things go, we talked about depreciation, right? And how assets um, lose value over time. We also have assets that gain value over time as well. Retirement stock, it can be looked at business to personal. Again, we're not going to go over appropriations of retained earnings. That's more so of a consulting thing. So if you want to know about consulting and retained earnings, you can go check out the website. Schedule compensation dividends as well. That's it. It kind of gets easier as we go along because of the understanding that you now have on assets and liabilities. Everything kind of generates or falls under these two things when we talk about financial freedom and accounting. And organization is key. Organization is very key. And organized plan out ahead of time is stature to how you generate revenue and how you move about your day. Today, you was kind of behind in that, but meaning when you're prepared for things, you have a better outcome than you do when you're unprepared. And that should be kind of common sense and self-explanatory. If you don't know that, hear that. Again, this show hosted at 9:30 every Monday morning. My name is Akili Paige, and I thank you for joining the F&E podcast.